Our country has witnessed government revenue declining from 20.2% of GDP in 1980 to 17.2% of GDP in 2010, where tax to GDP has declined from 19.1% to 14.5% in 1998 and moderately varied in a range of 13 to 15% thereafter during 2011-13, underpinning a low level of tax revenue for some time. In this background, concerns have been raised regarding fiscal responsibility, fiscal sustainability in the country in terms of Fiscal Management Responsibility Act, which provides a sound legal framework to phase out fiscal deficits and associated debt accumulation. More explicitly, the hypothesis that deserves to be examined is whether government revenue in Sri Lanka is too low and whether the government is concerned over the state of fiscal responsibility. Regrettably, those who speak on the subjects do not make reference to decline in government current expenditure from 24% of GDP in 1980 to 16% by 2010, that has stabilized around 15% of GDP during the period 2011-13, underscoring the fact that government has now managed a lower revenue deficit of around 1%, which was earlier 3%. This has been achieved as the level of recurrent expenditure has declined much faster than government revenue. Similarly, the country has seen a stable 6% of GDP ratio in annual public investments during last 7 years in comparison to less than 4%, along with an overall fiscal deficit below 6% of GDP as against 12% in 1980. The country's debt level, which increased from 77.2% in 1980 to 105.6% of GDP by 2002, is now around 78%. There are many other underlying reforms that I could go on to elaborate. In this background, if I speak only on taxation, there is no doubt that it would be an incomplete analysis as taxation would not have much meaning on its own unless it is taken up with other related components in government finance. Therefore, by combining taxation and related policies and operational components, I will speak on the title, The Contemporary Policy Trust of Taxation and Fiscal Policy in Sri Lanka, recalling again and again Lakmali's own contribution to this subject matter. Historical perspectives. Sri Lanka had a strong revenue base from colonial days of administration, revolving around a primary commodity export economy nurtured through plantation agriculture. The successive post-independent governments, after a short period of time, having exhausted the windfall benefits and international reserves that accumulated from Korean boom, adopted restrictive, inward-looking policies during the time of the Korean War that lasted till 1977, when the economy was reopened after having experienced many years of economic stagnation. The country also enjoyed a comfortable level of tax collection at the point of customs, as taxing imports and exports provided a good tax handle as opposed to having to tax agricultural income and land. The gradual deepening of the liberalization of the economy, along with global developments, required successive governments since 1977 to phase out export and import taxes and non-tariff barriers, except having to maintain maintain them on grounds of national security, health, environment, quarantine and quality assurance considerations to consolidate the economy in the backdrop of the global economy. This transformation also shifted the economy from a primary commodity export structure to a more value-added export structure. The result is that revenue from exports declined from 5% of GDP in 1978 to 0.3% of GDP in 2012, as exports are free of export taxes at the exporting country and were liable for tax only at the consuming country in terms of that country's tax system. The revenue from import tariff also declined from 4.5% to 1.1%, as tariff and non-tariff barriers are to be kept at minimum level except in view of exceptional balance of payment challenges. Consequently, trade taxes to GDP has taken a downward direction from nearly 10% of GDP in 1980 to 1.5% by 2000 and has remained around 1% thereafter, with several measures having been put in place, such as free trade agreements to further deepen global and regional trade. Successive governments till recently made several attempts to reform taxation, but they were ad hoc. There was a taxation commission appointed in 1992, but we did not see its recommendations getting translated into operations on a systematic direction. Several complex and distortionary surcharges and indirect taxes crept into the system, undermining a systemic expansion in the economy and thereby the tax base. The Board of Investment expanded its tax holidays and concessions to investments and project-related imports, creating a dual tax regime as well as dual custom regime, thus weakening the overall tax administration. As of mid-2000, the country's tax system was characterized with tax rate as high as 35% for income tax, with a social responsibility tax over and above income tax, financial sector taxation subject to a further 20% VAT, debit tax, and several indirect taxes operating at national and provincial levels, in addition to a wide range of exemptions and concessions under virtually all tax laws. All these made the tax administration complex, with the enforcement of multiplicity of taxes and cascading elements working at customs, with banking and domestic transaction-based multiple taxes.